Thank you, Del. Easy questions only, please, if you're going to have some Q&A. So let me just introduce our panelists real quick. So firstly, my name is Akash, part of Ventum. I'm a debt advisor, nothing too exciting. Here on my left, I got Ryan, Beautifi Solutions. They do point of sale consumer lending. Mickey is part of CaseMark, which is litigation financing. And Lauren is part of People's Group, People's Bank, which doesn't really need an introduction. I think everybody knows People's Bank. So let me get a seat here. Maybe I'll start it off, Lauren, with yourself, given you're the only funder on our panel. How have the rate fluctuations impacted your lending strategy?
Yeah, so when we're looking at providing a credit facility, we're looking at building a long-term relationship. And so a big part of that is looking at the viability of the underlying business. And so over the last year and a half or so, we've seen a couple of key trends that are informing kind of where we're going. So as interest rates are rising, we're finding a lot of our customers are not necessarily able to pass through that rate increase to the end consumer or small business. And so their margins are getting compressed, and that's having a knock-on effect on cash flow and potential viability of those businesses. And we're also seeing with rising interest rates, the events of default and delinquency within the portfolios are climbing. And so we've been monitoring both of those very closely, and that helps inform the business models of the companies that we want to be financing. And so we're moving away from some of the lower margin businesses that don't necessarily align with our strategy right now, and looking at those core businesses where we think that there's sufficient margin, that there's a viable long-term business that's going to be profitable at some point. Although I will say we finance companies through all stages, so not necessarily at a point where they're profitable yet. But that's definitely been a factor in shifting our strategy over the last year or so.
Do you think that changes now, given all these rate cuts happening and all of that?
Yeah, I think definitely we'll see some expansion of the margins, and I think that that's going to be helpful. There's businesses that have been, eating equity for a little while to sustain those margins. So we will see expansion. I don't know that it will change our strategy. We're still looking at sort of the viability of those underlying businesses, but for sure, seeing an improvement in the margin. I think the consumer delinquencies, we're not at the end of that cycle just yet. I think there's going to be quite a lag with the pressure from inflation, unemployment, and higher rates for an extended period. And so even with rates starting to come down, I think we're still monitoring that pretty closely.
Yeah, great. And then Ryan, you launched your business actually in COVID, right? While people were worrying about wiping their grocery down with Lysol and all of that, you launched a business. How has that been? Because that was a obviously very uncertain environment, and it's a lending business. So,
yeah, for sure. I guess maybe just for some more background on Beautifi. I launched Beautifi in 2021. Since launching, we've completed 2 equity raises and closed on 4 credit facilities. So just on the hamster wheel of fundraising on both the equity and the debt side. So there was uncertainty from the pandemic. Then there's also uncertainty from being a new business where there's a lot of assumptions. So when we looked at building out our programs, we actually realized fairly large advantage in the fact that we didn't have a legacy portfolio that was underwritten and originated in a low interest rate environment. So we didn't have any margins to be squeezed. We were able to build our pricing model, build our programs with that insight and information at hand. So I don't necessarily think it made things more difficult. If anything, I think it gave us a bit of a competitive advantage.
yeah, it's fair. If you can survive in COVID, you can survive pretty much anywhere, right? Yeah. And then what about any trends that you're seeing with borrowers? Are you seeing kind of things change over time? What are you kind of finding there?
Yeah, I think, early, we built our program with, higher rates in mind. And quite honestly, our first few credit facilities, we lost a lot of money. A lot of money. We lost money on a lot of deals that we were writing to be competitive. We make money now, so thank God I've started sleeping again. But, early days, it was harder to sell those higher rates to consumers. right? Because I think it takes a little while for consumers to sort of adapt and adjust and change their behavior. But where we're at now, we actually have been able to expand our margins substantially, and consumers are used to higher rates, from mortgages all the way through any other product that they have. So from a sales standpoint, we are performing very well and feel like we kind of have an advantage on the consumer behavior mentality standpoint. Now, in terms of loss rates, again, it sounds like such a positive story, but we got to be pretty picky early on. So we weren't lending to people we didn't want to lend to because we had enough flow and not enough capital. So our portfolio is performing very well. The areas that are struggling are kind of what you'd expect and probably what others in the consumer lending space have seen. The kind of near prime individuals having missed payments and delinquencies tick up a little bit more than the prime part of the spectrum, but still performing healthy, and knock on wood that remains the same.
And Lauren, I guess on that point, because you get to see a ton of different segments, are you seeing there be a pickup in any certain segments? Let's just call it within the specialty finance world, like point of sale, litigation. I'll kind of leave it open-ended.
Yeah, I mean, I think the subprime category kind of performed as we would have expected. Where we had some surprises in our portfolio was in the prime segment, where we found through COVID, you had a bump in credit scores that wasn't necessarily, reflective of the underlying profile. And so we found delinquency in that segment a little bit higher than what we would have anticipated under a stress scenario. And so, like I said, I think we're still working through that, and depending on how fast rates come down, will probably dictate how long that lag carries on.
Great. And Mickey, so you provide litigation financing. These are generally uncertain terms in terms of when you're going to get paid back. You got to wait for settlement and proceeds to come in. How have you been able to manage, your facilities, your business, your sales cycle in these environments? Yeah.
So hello. Oh, can you hear?
Yeah.
Okay. So we always have duration risk and that long-term issue top of mind because we don't know how long our credit is going to sit out there. And we're obviously borrowing in real time and have to service that debt. And so I think very much to Lauren's point, the spread matters. And when you're, as an originator or a credit platform going to market, it's very easy to decrease rates and pass along savings to consumers and borrowers. It's hard to raise them back up. That can get very sticky and challenging. And so I think, in a low rate environment, there's a lot of competition with other market participants who try to pass along those savings and originate increased portfolios, but then you run into delinquency issues when the rates change on them. And so for us, margin and that spread is always top of mind, and we forego some of the origination in exchange for that, and we're comfortable with that.
Yeah, I mean, in the end of the day, NIM is the name of the game, right? Everyone's got to manage that. Any comments from anyone in terms of, how have you kind of experienced your NIM compressions, and how have you kind of battled that over time?
Yeah, I mean, maybe for us, the bulk of our funding is forward flow. So what we care about as a business right now, especially in kind of a rapid growth environment, is cash, right? We want cash today versus cash over the long term, and we're willing to give up a little bit of NIM for more money today. It also protects us. I mean, we're still servicing those loans. And of course, there's parameters within these facilities that we need to remain within. But we're not necessarily subject to all of the kind of variation and risk over the course of the term, which for us often is 3 or 4 years. So I think that's one way around it, and having different facilities where you can tranche out different aspects of your portfolio gives you a little bit of flexibility to keep some risk on balance sheet, flip some risk off earlier on for cash today.
We take a little bit of a divert approach to NIM. I think it's always top of mind, and we're happy to forego some origination to have that cushion and that spread, just because there is unpredictability when you're writing paper to consumers and borrowers at a fixed rate, but you're borrowing at a floating rate. I think that's where we all know the stories where that spread just was not sufficient, and it seems like a great play and a good story when the credit portfolio is increasing during those heavy growth years, and then something happens and the chickens come home to roost. And so that's always top of mind, because 3-4 years down the line is typically what we see is where your result shakes out.
I think one of the other trends we've especially seen over the last year, and part of our business is in embedded finance and deposit as a service and money movement services. And so we've seen a lot of our customers start to diversify, where they may have started as a pure lending business, but have then moved into how do we fully franchise those customers and keep them within our ecosystem across multiple product lines. And so we've seen that as a way for some of our customers to insulate that margin compression and kind of create diversification in their business as well.
Are there any kind of creative pricing strategies that anyone's used, like whether it's fees or whatever the case is? Anything to comment there?
Yeah, I mean, we use a wide sort of varying range of fees and interest to kind of get the APR we need to see. We kind of ABC test frequently. Now, we're not making drastic changes that we're sort of fingers crossed praying that they're going to pan out. But yeah, I think we get quite creative. We even have certain situations where the merchant, in our case, typically clinics, will actually fund part of the interest or fund part of the fees, and coming up into arrangements with those merchants to help generate a return that we need to feel comfortable taking on risk. So I think getting creative is important, and it's kind of like in the DNA of Beautifi. I mean, we're 50 people now, so growing, but still a small business. But I think like data analytics and reporting and having this data and looking at it on a daily, weekly, monthly basis and starting to make small tweaks and changes and monitoring those is important.
Yeah, and then I guess, Lauren, as a bank, you probably have less levers, I would imagine, than others.
Yeah, I mean, we're always looking at how do we make sure we're getting compensated appropriately for the risk that we're taking. And so, our facilities are very bespoke. Everyone looks differently. So the combination of covenants, how you might put borrowing-based structure in place, and having tiered pricing so that we get additional yield if the risk starts to deteriorate. But it also means for businesses that are earlier, where they may be going through a period right now where portfolio performance is a bit softer, as things improve, they're able to get more and more competitive pricing. And so I think that's one of the ways that we see pricing our facilities is, we might start in the middle tier, and as things improve, there's that ability to automatically unlock price savings.
Great. So just to shift gears a little bit, there's a lot of attention being paid to private credit, particularly out of the U.S., a bit here in Canada, but particularly out of the U.S. How has private credit changed anything for your businesses? How have you viewed it? Maybe you guys can comment.
Our first two facilities were kind of alternative lender private credit, and they're incredibly expensive because at that point in time, we'd originated a very small number of loans. They hadn't seen a full vintage run through, so a lot of assumptions. But without them, we would have died, definitely. So I think, having private credit, having an appetite for this type of product and for these, this type of risk it's important. And it was a stepping stone for us in terms of launching a new product and a new program. And as we're looking to spin up some new programs in the U.S. and in Canada, having a lot of conversations with different private credit groups. I was at Money 2020 last week in Vegas and probably had 30 different conversations with private credit groups. So there's a lot of them out there. There's a lot of appetite. But I think, again, as a borrower, you're just weighing that balance between how much flexibility and openness and uncertainty can you sort of bury into this facility, and then there's obviously an associated cost with doing that. So for us, and I think it will continue to be the case until we can fund with more and more equity, but as you launch new programs and products and try and get creative, you're going to have to tap those private credit funds now and again.
So there's definitely a lot of dry powder, to your point, in the U.S., and banks and credit funds are just really pushing into the private credit sphere. Yields I spent a lot of time in the U.S., and yields in the U.S. tend to be higher. The requirements for these credit platforms historically have been much higher than what you'd see here. In the CaseMark platform, we still prefer Canadian lenders, and we bank with Canadian lenders who typically price off of prime. At the time of LIBOR, you were seeing like LIBOR 900, LIBOR 11 was a normal quote for specialty finance platforms. Now SOFR 700 was, maybe like 12 months ago. We have funds calling and offering SOFR 400, which starts to be competitive with what you're seeing from Canadian banks. And that's just a function of how much money is out there that they cannot deploy. And just something to keep in mind with the US credit funds that's interesting, and I imagine a lot of people are reading or seeing about it, but the revenue numbers that a lot of these private mega funds are posting in their private credit platforms, more and more of it is being made up of payment in kind. And so you're seeing like 5, 10, 20% of top line interest revenues being payment in kind, meaning that the borrowers, the credit platforms that they're lending to are not actually servicing the debt in cash month over month. And that's a trend that's increasing. And the underlying problem is because the originator borrowers have something amiss in their books. And that just hasn't really surfaced yet.
I mean, I would agree that private credit plays an important role. At the end of the day, there's a number of banks here, but we're all pretty selective about the deals that we're going to do. And I think when you look at the cost benefit, taking an expensive private credit facility early on to allow you to scale your business, get to kind of a critical mass, test your model, get comfortable, and have a bit of a proven track record before you approach a bank can be beneficial. And it may still be cheaper than you going out and raising equity to be able to make it through that phase of the growth. And so I think it plays a critical role, and it's really about weighing the cost benefit of equity, slower growth, and the cost of these facilities. And it's unfortunate we don't have more active private credit in Canada. There are some, and there's a handful that are playing in this space, but not as many as the U.S. And so it's just a much deeper market. But there is complexity with dealing with cross-border, how are the logistics of borrowing, what currency are you borrowing in, how are you managing that hedge exposure. So all of that introduces additional complexity, but it can be an important step in growing the business.
Yeah, I go to a conference every year in Vegas, DealMax, and to meet with a bunch of credit funds, and you realize the U.S. market is just so much deeper from that element. You've got, sponsor-only focused, credit funds, equipment-only, XYZ. So I think, you're seeing a lot of that starting to creep up. Not even starting, it's been creeping up here in Canada. A lot of these U.S. credit funds starting to play more and more of a role with Canadian originators, right? Which is, good and bad. It's good because it's providing access to capital that some of these originators wouldn't have had. But it's sort of bad because it's like, Canadian companies should be supporting Canadian originators, right? So it's going to be interesting to see sort of how the next several years play out, but it's definitely an important part to the overall strategy. So maybe this is a little bit of a leading question, but if you were advising borrowers today in raising a facility, what would you recommend being some of the best steps they can take in order to secure sort of the best facility that makes sense for them?
All right, I'll jump first on this one. I'm actually looking at Mo there from Juno Financial. For me, a key was finding great advisors. I think and Lauren, you'll probably agree with this. It adds a lot of confidence for lenders when they know a business has partnered and has advice and support from others in this space that they know and they trust. And as a new business building these relationships with lenders, or like an existing business building a relationship with new lenders, you need to build that element of trust. So, leaning on advisors that can understand you, understand your business model, and start to sort of advocate for you, support you, and help you navigate the different private credit funds or solutions with different banks and bigger lenders, and even just help paint the picture for strategically 1, 2, 3 years from now, here's who you got to be talking to, is incredibly helpful. And then I think the second point off the back of that is being proactive. Once you've identified, and hopefully you have a sense of what you want to be building or what your product or business may look like in 2, 3 years' time, start those conversations. Start verbalizing that. Start building trust with the lenders, so that they understand, they get the vision, and then when you start to execute on it, and it becomes time that you need support from those lenders and to spin up these facilities, a lot of that work has been done, and you can actually get into it.
Yeah, I would say two things in addition to having a great advisor that's able to translate your business to a banker that may look at a whole lot of different types of businesses is important. But I would say like a couple things that we see pretty frequently is unrealistic growth objectives. So we look at businesses that are still fairly early, and I think we would prefer to see a more moderate growth case, and maybe here's the aspirational. But we do regularly get borrowers that come in that ask for the moon because I'm going to grow my business this quickly, and there's so many opportunities, and then we get a year into that relationship or 2 years in, and the growth hasn't necessarily materialized, and it's a bit of a loss of confidence in terms of the understanding of the market that they can reasonably go after, but also in the early stages, you may not want to grow so aggressively because at what cost are you growing? And then I think the second part would be sort of hitting the challenges straight on. We've seen, especially over the last couple of years, portfolios have had mixed performance, and having a company that's really prepared to talk about what maybe hasn't gone well, where they've made modifications to their origination strategy, to their credit model in order to respond to those things in the market, rather than kind of brushing them aside, is also, I think, an important part. I mean, banks are in the business of taking risk. We understand that all the lenders here are taking some amount of risk. So being able to talk about what's working, what's not working, how you're addressing it, and making sure that we're kind of pivoting as we need to through the cycles, I think is another really important part that we look for in making sure that management is prepared to take on the risks that they are.
So I would concur with both that great advisors really make a difference. I mean, they save you the brain damage of figuring out where to go, how to present your case, and there's just an efficiency and a level of trust, I think, that comes with all that. And the second is, to your point, as an originator, just don't lose sight of the NIM. It matters. It's easy to draw down debt. It's easy to flood the market with money. It's a different thing to get that back, because even though you think you have a great portfolio on paper, you will have to pay back the debt either monthly or at some point. And what we've seen over the last 18 months, and it looks like it's continuing on, is really a result of growth at any cost, or spreads that were not pricing risk correctly. So I think it's important to be mindful of that. And just speaking with lenders, you don't get what you don't ask for. And so they're in the business of putting out money. If you have a good platform and a good business, be mindful of what your business actually needs and the parameters that is set up at.
Great. All I heard was hire advisor. That's all I heard. Yeah.
The purpose of the panel.
Yeah. Look, I think we're up on time, so thank you everybody for joining us. Thank you, panelists, for sharing all your thoughts. If we got time for Q&A, sure. Anybody have any questions? Because nobody is stopping me from talking, so I can keep going.
Quick question. So, question for Mickey and then a question for you, Lauren. Hedging. You talked about it very variable interest rates. I know your timelines are choppy or unknown. Sorry. The question was hedging, and I know with litigation timelines are long but indeterminate. Have you considered hedging? And the question for Lauren is, generally, are your bankers insisting on hedging? Because I know ours typically do.
So, thankfully, our bankers don't insist on hedging. I'm not sure that it would do anything but add, in my view, unnecessary cost, because if you have good credit parameters, then the duration risk for us just is accretive from a revenue perspective. And depending on the stage of the business, like in my case, we can service the debt and just wait. We're happy to wait. That's the name of the game. So the short answer is no, and I don't think that it would be, accretive in our circumstances, but perhaps in some business.
So we don't require hedging, but for sure it's a factor when we're looking at facilities. And so, part of our shift has been towards shorter term assets because we don't have that risk. We have in the past financed very, very long-term assets, and that was fine when interest rates were relatively stable, but caused some pain over the last couple of years, and so we've had some learnings from that. I think we would need to look at what is the margin to kind of compensate us for that outlook. I think sometimes banks are fortunate in that we have a whole mixture of assets and liabilities in different durations, and so we may be able to sort of sustain that kind of volatility that you might see in a longer term asset, but it's for sure a risk, and we tend to look for shorter AM assets for that reason.
If you're referencing Forex risk, then in my view, for sure, especially in this environment, but yes, always.
The answer is yes. So for context, so for us, our credit facility, which is floating, doesn't require us to hedge our credit facility, but other facilities we hedge. And our credit facility generally requires us to hedge, including Forex, but there's also the duration risk.
Yeah, the Forex hedges have come, that pricing is compressed,
Yes.
which is very attractive.
Any other questions? Okay. Thank you, everybody.